Welcome back to the deep dive. Today, we are taking a trip into the high-stakes world of perpetual futures.
A world that for many is just pure confusion.
Exactly. And we're diving into the one fundamental mechanism that really governs whether you survive or get liquidated, the difference between last price and mark price.
And this is so critical. If you're trading these high leverage contracts, you're always managing risk. But what happens when there are two prices on your screen and, only one of them actually decides your fate?
Right. So our deep dive today is designed to be a critical shortcut, a way to finally clarify the relationship between these two numbers.
We've gone through a stack of materials for this one, exchange white papers, a ton of trading guides, even some post-mortems on massive liquidation events.
And here is the core thesis, the one thing you absolutely need to walk away with. The last price is what executes your trade, but the mark price,
Yeah.
that's what protects your position and ultimately determines if you get liquidated.
I mean, think about it. If you're just looking at the candle charts you see every day, which almost always show the last price, you are making huge decisions with, frankly, incomplete information.
Okay, let's unpack this system then, because we're dealing with two prices that seem like they should be the same, but they have totally separate jobs. Let's start with the most obvious one, last price.
Right. The last price is, well, it's just what it sounds like. It's the most recently traded price on that specific exchange's internal order book.
So a buyer meets a seller, a transaction happens, and boom, that number is the last price.
That's it. It's local to that platform. It's immediate. It's the reality of what's happening right now in the order book.
But then we have the mark price, which is a whole different animal. It's like the official referee in the game.
It is. The mark price is a calculated reference price. You can't actually trade at the mark price. Its only job is to reflect the true global fair value of the asset.
It's the exchange's internal lie detector.
A great way to put it. It's there to assess your account health objectively without all the local noise.
So, using an analogy from our research, the last price is like the price being shouted at a chaotic local auction. But the mark price is the official, government-verified price based on an average across 10 major markets.
And that shield is absolutely necessary. Without it, the whole system would be catastrophically unstable in a high-leverage environment.
That sounds dramatic, but I think the drama is warranted here. We're talking about malicious actors, right?
We are. I mean, if exchanges only use the last price for liquidations, a whale, a trader with huge capital could just come onto a single, maybe less liquid platform.
Just dump a massive order.
Exactly. They could execute a huge buy or sell order that would drastically move the last price on that one exchange, even if the global price of the asset didn't really change.
Creating that infamous scam wick.
Precisely. That sudden localized spike or crash. If that wick momentarily hits a big cluster of liquidation points, that one whale could unfairly wipe out thousands of positions in seconds.
And we've seen this happen. I was reading one of the postmortems about a case where a single 50 BTC order on an isolated exchange just caused this massive deviation that wiped out millions.
It's why the mark price is the critical safety valve. It steps in and basically says, hang on, the global market hasn't actually moved that much. We're going to ignore this little panic on this one platform.
So your position is only liquidated if the global fair value truly moves against you.
That's the protection. If the last price spikes down 10% in a flash, but the calculated mark price stays pretty stable, your liquidation risk remains low.
Which also means my displayed profit and loss, the unrealized PnL, is tracking that stable, objective mark price.
Correct. And that objectivity is everything.
Here's where it gets really interesting. If this mark price is the all-knowing fair value, how is it actually calculated? It can't just be an arbitrary number.
No, not at all. It's built on a rock-solid foundation. The calculation really has two main parts. The bedrock is something called the index price.
Okay, what's that?
It's simply a weighted average of the asset spot price, pulled from several major global exchanges. So, Coinbase, Kraken, Binance, a few others.
So by averaging them all out, you prevent one exchange having an outage or someone manipulating one price from corrupting the whole system.
Exactly. It ensures global market integrity. So that's our baseline. But futures contracts aren't spot. They have their own dynamics.
Right. They carry expectations, premiums. There's a tension there.
And that brings us to the second, more abstract component, the funding basis.
Okay, break that down for us. Funding basis sounds very mathematical.
Think of it as the cost of tension or maybe the cost of desire in the market. If everyone is piling into leveraged long positions, the futures price will naturally trade at a premium to the spot price. That premium is the basis.
So the funding basis is a calculation that sort of accounts for that premium and keeps the futures price from drifting too far away from the real spot price.
You've got it. It represents how much the market is willing to pay right now just to hold a leveraged position on that contract. So the final mark price isn't just the spot price. It's the global average spot price, adjusted for the market's current sentiment.
That's why they call it fair value.
Yeah.
It's a much more complete picture.
It is, and exchanges all have their own little tweaks. BitMEX, for example, used index price plus the fair value basis. Binance often does something even more robust.
What do they do?
They often take the median of 3 different prices. So they'll look at the index price adjusted by the funding, they'll look at a 30-minute moving average, and they'll look at the contract price itself.
Why the median of 3? Seems complicated.
It's all about filtering out noise. By taking the median, if one of those components temporarily spikes because of, say, a high-frequency bot, the final calculation stays centered and stable. It's an extra layer of defense.
The level of detail there just shows you how serious this war against volatility is. Okay, let's switch gears. How does this actually show up on my balance sheet? PnL and the scary one, liquidation.
This is where the confusion really peaks for most people. Unrealized versus realized profit.
Right. So when I'm in a trade and I look at my terminal and it says my position is up or down, say 50%, that number, the unrealized PnL.
That's based on the mark price.
Okay.
The exchange is using that stable objective mark price to give you a health check on your position.
Yeah.
It's ignoring all the temporary local froth in the order book.
But the second I hit that close position button, my realized PnL, the actual cash I walk away with, that's based on the last price.
Precisely. Because to close your trade, you had to execute an order against the live order book. And that execution happened at the last price. One tells you how healthy you are, the other tells you what you actually made.
So when does the mark price stop being the nice objective referee and become the executioner?
When it triggers liquidation, the value of your position is constantly being marked to the mark price. Liquidation happens the second the mark price moves far enough against you that your collateral drops below the exchange's minimum requirement.
The maintenance margin?
The maintenance margin. So if you're on high leverage, even a small move in that official global mark price can just evaporate your margin, and the liquidation engine steps in and closes the trade automatically.
To bring back the analogy, you're only broke when the official government-verified mark price says you are. The last price candle on your chart could look fine, but your survival depends on that silent number moving underneath.
And this brings us to the real danger zone. When these two prices diverge significantly.
What causes that to happen? What are the signals?
Divergence is a huge sign of market stress. Number one is just low liquidity, a thin order book.
Right, so a decent-sized order can just blow through the book and send the last price flying, while the mark price, which is based on the global average, barely budges.
Exactly. Another one is extreme market sentiment, which goes back to that basis we talked about. If the funding rate is through the roof, it means there's overwhelming demand for leverage, and that can pull the futures price really far away from the spot price.
And of course, the obvious one, manipulation or just a big news spike that hits one exchange first.
And this is where traders feel cheated. It leads directly to the most common mistakes.
Let's nail this down. So I'm looking on my chart, I see a big wick go down, but it doesn't hit my stop loss. I breathe a sigh of relief. Then I get the notification. Position liquidated. You're saying that wick I saw was a lie.
Well, it wasn't a lie, it really happened. But it was irrelevant to your survival. That's the number one myth, thinking the last price chart dictates liquidation. You were liquidated because the mark price, moving silently and calculated independently, did hit your liquidation level.
And the second big mistake has to be about stop losses then.
A huge one. People set their stop losses based on the visual chart, the last price, and they put it way too close to their actual liquidation price. The problem is the mark price is the real threat to your margin, so it's very possible to get liquidated by the mark price before your last price stop loss ever gets a chance to trigger.
So what does this all mean? We've gone through the technicals. How do we turn this into practical, actionable rules for risk management?
Okay, we can boil it down to 5 core defensive steps. And rule number 1, it sounds simple, but it is everything. Use conservative leverage.
It's the foundation, right?
Yeah.
Lower leverage just gives you a much bigger gap between your entry and your liquidation price. It's your survival zone against the mark price.
It is. Rule number 2, utilize isolated margin. In a game this complex, you want to contain the damage. Isolated margin limits your loss just to the funds you put in that one trade.
So if the mark price does take you out, it doesn't wipe out your whole account. The damage is ring-fenced.
Exactly. Rule 3. Be proactive. You can't just set it and forget it. If you see the mark price moving against you and your liquidation price is creeping closer, you have to consider manually adding more collateral.
Which pushes that liquidation price further away and buys you some breathing room.
Right. Rule 4. Set your stops with a big buffer. Forget what the chart looks like. Place your stop loss well before your calculated liquidation price.
And you have to check your exchange settings right. Some let you trigger the stop loss based on mark price instead of last price.
You must do that. If you can, always use a mark price trigger. It aligns your own risk management with the actual liquidation mechanism.
And Rule 5.
Monitor the basis. Monitor the volatility. When you see a wide spread between last price and mark price, or when the funding rate is spiking, that is a flashing red light. It's a warning that the market is stressed and unpredictable.
So you need a little checklist on your screen. You should be watching the mark price, the index price, and the funding rate. And of course, your own liquidation price and maintenance margin.
That's the full picture. That's your true risk exposure, completely independent of whatever the last price chart is doing.
So this whole deep dive really shows that in perpetuals, you're trading under two different rule sets at the same time. The last price is your local momentum, but the mark price is the objective speedometer the cops are using.
That's the vital distinction. Last price is for execution. Mark price is for protection and risk assessment. The chart you see is usually last price, but your financial survival depends entirely on the mark price.
And that leads us to a really interesting final thought for you to consider. We've established the mark price is built to be this fair, stable anchor. But a key part of its calculation is that funding basis, which is constantly shifting based on short-term demand for leverage.
Right, it's reacting to the market's frenzy.
So if the mark price provides global fairness, but its own calculation is continuously being tweaked by these short-term, sometimes irrational premiums, what are the broader systemic risks created by that constant tension? Does the protection mechanism itself inject its own kind of instability by always trying to adjust its own definition of truth?
A mechanism designed for stability, but with a core component that's constantly chasing sentiment. That's a question worth pondering.
We'll see you on the next Deep Dive.